Familia, I appreciate you being here with me still. You could say that we've reached the end of, well, never mind the title. Cause this is life and it's still being written. And if you think about it, there is no end, just chapters and intersections. I'm at the intersection, somewhere between earth and heaven, birth and death and resurrection. Looking back on the map of my life, reflecting and rapping my introspection. The curses and stress and learning of lessons, losing direction. The pain and depression's what made me mix music and message. And it took so much being written.
Hey guys, Gina Butson, Real Estate. Welcome back. On today's show, we are going to discuss the 5 C's of credit. Not sure why my voice is so deep. Hey. So, this is actually probably the 4th or 5th take. I'm going to start working on how to edit and chop it up and cut it up and slice it up. And it's a little bit hard because I do this in one take. So if I mess up, it's a wrap, to the trash, delete. And I went through one of the shows or one of the episodes, and it just seemed, it just felt dry to me. And I guess because it wasn't that I was reading, but I don't know. I just didn't like it. So here I am again, attempting number 4, take 4. And I actually want to read a little bit because I think the information is important, because covering the 5 C's and what affects your credit and what you can do to actually get points for your credit score and not have it taken away. I think that the information is super important, but like the delivery was whack. So I want to just read a little bit and then kind of talk to you guys about it and give you my own experience, because when there was a time back in 2000 when my credit score was like 540-ish. And I would pay all my cards on time. And, I was like, I just couldn't get out from the 5s. I couldn't. And it was because what you don't know, you don't know. I didn't know that I was maxed out in the credit world. And I didn't know that paying my bills on time wasn't enough. It wasn't enough to, raise my score. The damage had been done. I think I had like a Kaiser collection. I had a cell phone collection. I had, there was like 3 different collection accounts that I had that in my mind, it was only $100 collection, whatever. I'll pay it when I pay it, young and dumb. And so that mindset, like I just carried that bad credit luggage around with me, not knowing, can you look in that bag, Gina? Because in that bag, there's trash and you need to take care of that stuff. And so once I learned the secret sauce of how to get my score up, it made a difference. And, I ended up going from like 540 to like 740. And I remember when I started seeing my score going up, it's a big deal. It's a big deal when you check your score and you're just disappointed. So these are the things, these are the days of our lives. Every time I start to say something, like my mind like goes everywhere. So that's why different streets and roads take us down, and then I exit, and then I jump back on the freeway. Like it's crazy. So these I wanted to cover. We will cover the 5 C's. Don't get me wrong, guys. But I do want to cover what I feel is just as important, and it's how your score is broken up. What matters? Everything matters. Don't get me wrong. But what takes priority? Okay, so you pay on time. Yay, but you don't get points for that. Boo. So, So here we go. I got you guys' back. We're going to do this. Payment history. Your payment history, as you all know, super key. You miss one payment, boom, your score goes down like 60 points. Then you pay it on time, Guess what? You don't get those 60 points back. You've been judged, and they take them away. They're so greedy with how they give the points back to us. So it's truly, it's hard. It's hard to recover from one missed payment. And so this is a perfect example of what you guys need to do and what matters. So payment history, make sure you pay everything on time. You definitely don't want mortgage lates. Ouch. If you do, I have some loan officers that can help you and possibly improve your score. We can get into all that later. Okay. Payment history. Payment history is actually 35% of the 100% of what calculates your score. Where did your score come from? How do they even figure this stuff out? So it's payment history. That's 35%. So you're paying on time, right? You're not improving your score, but you're not losing any points either. So payment history, 35%. This is probably the most missed or unknown how your credit is calculated, analyzed. It's actually your credit limit versus your balance. So for easy math, we're just going to say your credit limit is $1,000. On that credit card, you never want to go above $300. I know it sounds ridiculous. And if you would have told me that 30 years ago, no, that's bad math. If you would have told me that 20 years ago, I would have thought paying my bills was enough. I would have thought that you gave me $1,000. I'm using $1,000 credit and I'm paying it on time. What's the big deal? Why is my score going down? So it's a 30% threshold. So your $1,000 limit, your $500 balance, now you're not getting points, positive points. They're not taking any away yet, but you're not getting any. In order for you to have credit report positively and get points, you cannot go above 30%. $1,000 limit, do not go over 300 balance. I know it sounds ridiculous. That's just the number they picked. If in the credit world, if your balance is over 50%, so if your $1,000 card, your balance is 505, 565, you're paying on time, you're thinking everything's great, I have good credit. In the credit world, you're actually on the verge of being maxed out. Even though to the normal person that just, why would halfway be maxed out? Right? I mean, I'm not maxed out. When I was younger, it was over your limit. If I was maxed out, my balance was $1,200 and my limit was $1,000. To me, that was maxed out. So it's a mindset. You guys have to erase what you thought you knew, start over. Someone's giving you good information. You have to let go of bad information or advice that someone's giving you on what matters on a credit score. Okay, do not go over 30%. We got it, right? Easy. Okay, number 3, length of credit history. So payment history is 35%. Amounts owed, balance versus limit. Balance versus limit is 30%. So now we're at 65%. What's left, right? So length of your credit history. This goes, if you have an old card and you have zero balance, but it's the oldest card you have, that's reporting, they're analyzing, okay, Gina's had a credit card for 20 years. And so my established credit is good. I've been doing this a long time. I finally got it right. And so your length of credit is 15% of your score. So if you have that card, pay it off, but don't close it. Let it stay open, because that's your credit profile. You want to have a credit profile that dates back to the end of time, just for, the longer the better, of course, 5 years, 10 years, 15 years. Let that card sit there with the zero balance. It is still showing, it's one of the C's, it's character. How long have you had credit? How long have you been doing this? Did you figure it out? Do you have it right? Like, truly, the stuff comes into play, and it's what's analyzed. So length of credit history, that's going to be 15 points of your 100. Credit mix. So there's different types of credit. Debt. You can have revolving debt. You can have installment debt. You can have your mortgage loan. There's different types of credit, and that's how it reports. So let's say all you have is retail charge cards, Walmart, Target, Macy's, those are all revolving debt. If you have revolving debt and installment debt, like your car loan, student loan, those are different types. So you get points and more points, because it's showing you don't just have one type of debt. You've now expanded and you're starting to grow, and you have, your credit profile, you have history there. You have good payment history. You've been established a long time, like all this stuff. A lot of moving parts, guys, lots of moving parts. And the last 10% of our 100 of how our score is calculated is when you apply for a new card. That inquiry stays on. That's going to be 12 months. The average credit inquiry is 12 months. And so it'll fall off. So let's say you want to go buy a car. You go to the dealership, they run your credit, and they'll run it. They'll run it with Patelco. They run it with Wells Fargo. They run it with, like, it's boom, boom, boom. And if you actually look at your credit report, you kind of freak out, because you're like, oh my God, I went to buy a car and they ran my credit 10 times. They didn't technically run it 10 times, but when they ran it, you're not going to get hit individually for each inquiry, because you were buying a car, because it was all ran at the same time on the same day. You are not getting a hit each inquiry. It kind of falls under this safe umbrella. It's the same thing with when you go to refinance or have your credit ran and you want to shop around and another mortgage lender runs your credit. You have a time period where you can do that and it's not going to affect you. Where new credit can go terribly wrong would be during Christmas time. You go to Kohl's, 10% off if you apply for a card. And in your mind, you're thinking, okay, whatever, I'll just apply. I'm not going to get approved anyway. Do it. So you have them run it. You get your 10% off. You get that hard inquiry hit. Boom. You keep shopping. You go to Best Buy. They tell you the same thing. You can get money, save a percentage if you apply for a card today. Doesn't matter if you get approved or not. That's what they tell you. And then you have that ran. Boom, another hard inquiry. So you're not getting approved. You're having these inquiries. You're taking these hits. And that's where new credit, this 10%, can be negative. Now, if you went and you're shopping at Home Goods, because me and Kelly love Home Goods, and they offer you the card and you get it and you get approved, that is okay if that's all you've been doing in the last year. You kind of want to spread stuff out. I always thought in my mind, if someone asks for my social security number, the chances are they're running my credit. Of course, that's how to identify us. But if a company is asking for your social security card, social security number, chances are your credit is being ran. You are going to take that inquiry, so you would take a hit there. You would take a hit. You do not want to apply multiple places at the same time that are different. I want to get a mortgage. Let me try to see if I can buy this house. Boom, hard inquiry. Okay, well, we didn't qualify for that, so let's just go get that car. Boom, hard inquiry. It's Christmas. Get that car. Boom, hard inquiry. So that's where you start losing points. So basically, you just want to keep that pretty much spread out and don't apply for credit, often. If you get one, great, establish, and then build your credit empire. So we've gone over how scores are calculated. Now I want to discuss what the 5 C's are, because I know I mentioned that on the last show at the end. That's what I wanted to cover today. And so the 5 C's is going to be character. Kind of touched on that a little bit. The character is you. How does your credit profile look? Have you been doing this a long time? Do you have a stable job? Have you lived in your house more than 2 years? Like, different things just get analyzed. So that's going to be your character. Then the second C is going to be capacity. And this is where it's going to measure your ability to pay the loan back. In the lending world, this is called a DTI, debt to income ratio. I always want to say we. So it's so hard because I still sometimes have my loan officer hat on and I just can't take it off. I don't know if I have the one that switches around and one's agent and one's loan officer, and I just I don't even have to take it off. It's just like a spin thing. So it is, second C is capacity. Can you carry this debt? How much do you make a month versus how much debt do you have? Your car loan, your student loans, your revolving debt. What is that total number for the month? And what is your total number of income for the month? We divide those. That percentage is how we calculate your debt to income ratio. You want to stay around 45%. I know Fannie Freddie, it's a little bit less, but when you run it through the system, through the automated underwriting system, it will accept one over the threshold as long as you have compensating factors. Are you high risk? Are you have risk? Have you had a BK in the last 7 years? Do you jump around at jobs a lot? Have you lived in the same house? Have you rented, for more than 3 years somewhere? All this stuff, guys, this is analyzed in like 20 seconds. When you hit DU, it calculates and lets the underwriter know, is this going to be a viable loan? And it literally just dissects you. It's like the little forensic team, is digging through your credit and looking and, just analyzing everything. And so number 2, that was capacity. Number 3 is going to be capital. Capital is, what's the easiest way to say this? How much skin do you have in the game? So let's say you went to go buy a house. Minimum down was 3%, FHA 3.5%. Are you able to come in with the minimum down? Do you still have assets left over? Are you doing a down payment assistance program so you don't have that much skin in the game? It's still a good loan, but how much are you really invested in this? If something happened to you and you couldn't pay this mortgage loan, is there a loss to you? So the more skin in the game you have, if you came in and paid, 50% of your house and the loan that you got was only 50% of the purchase price, guess what? Your whole body's in the game. It's not just your skin. All right. So number 4, collateral. This is what lenders can take back. So say you default on your loan, you default on your car payment, your collateral was the car. So they're going to come repossess that. Your collateral on your loan to purchase your home was your home. So the collateral is the object that is tied to the loan that you are trying to get approved for. So basically, it's the item that you're financing. All right, on to number 5. So number 5 is, last but not least, conditions. So this is going to be the conditions of the loan, the interest rate. Conditions can refer to the borrower, their current job, future stability, examining your income, how stable is your income, what's the length. Conditions and character are a little bit similar as far as the overall credit analysis of what you're trying to accomplish. What are you getting? It's really just the big picture. They're going to look at economy trends. What industry are you in? With this pandemic, it threw everything off. So truly, conditions is a little bit different. And I think they go more in depth now because depending on what market you're in, as far as industry, it could absolutely come into play that the underwriter wants a little bit more documentation, because now this is one of the first industries that's affected. We're in a very strange economy right now. So this is a huge game changer in this whole process, because now they're looking at, it wasn't just a 2-year history of job stability. Now, can this be affected, what industry you're in? So that's going to be kind of the future stability that they will be trying to review. And, you'll just have to prove, hey, during the pandemic, of course, when the world was shut down for the first 2 months, and then some of us, like in our industry, we did not get a break. A lot of people were at home. We've pretty much in lending, and gosh, I always say we. There was a time when we had maybe a week or 2 because title, escrow, they shut down. We couldn't record. And so there was a really iffy time during there. We didn't know, we kept processing our loans, but gosh, was it even going to record? Was it even going to close? No one knew at that time where this was all headed, where we were going. Rates hadn't hit rock bottom yet. And, everything that we had going on, there was no real break for us. And I think once the floodgates opened up and we all figured it out, because the crazy thing is everyone wanted to work at home in our industry, and it was kind of frowned upon. I knew at some of my old companies, they didn't want you working at home, and that was not normal. It wasn't the usual. Well, guess what? It's the usual now. And because we were all so used to being remote sometimes, so you'd go on vacation, and I remember back in the day, you could take a loaner laptop when I was an underwriter. So you could take a loaner, check it out, leave your ID. No, I'm just kidding. And that was the way it was 15 years ago. You just weren't remote. And so now that that's changed, this number 5, the condition, maybe a few months back, maybe last year, this held up a lot of people from getting approved. But now it's changing. We're evolving to work at home. Obviously, we're all making adjustments. So don't be scared of this last condition of your job stability, getting this loan. Just be ready to evidence why, they might not even question it, but they might. And as I stated previously, a good loan officer, they're already waiting for this. They already know, because it happened on 2 loans prior to this one, and all we needed was a letter of explanation, to get us past this. So now that we've covered all 5 C's, I hope this helped you guys. I know it's a ton of information. If you have any questions, please call me, reach out. I'm always here. I'm probably editing a video. Just reach out and call me. All right, you guys, I love you so much. Thank you for all the support. Make sure you guys subscribe, get your friends to subscribe, and I'll see you guys next week. All right, love you guys. Bye.
Look, Mom, I did it.
Gina. I like Gina.
You like Gina?
Yeah. Gina, name Gina. I want Gina bird.
Familia, I appreciate you being here with me still. You could say that we've reached the end of, well, never mind the title. Cause this is life and it's still being written. If you think about it, there is no end, just chapters and intersections. I'm at the intersection, somewhere between earth and heaven, birth and death and resurrection. Looking back on the map of my life, reflecting and rapping my introspection. The curses and stress and learning of lessons, losing direction. The pain and depression's what made me mix music and message. And it took so much to get here, but now the view is majestic. I guess these many graves then gave me perspective. I've seen it sometimes right behind the grief is hiding the blessings. And other times it is what it is and the globe still spins. We cry those tears and dry them.